This is our Suburb Trends report for November 2023, and we'll be looking at what property investors need to know when they're looking at investing across the country. And in this episode, we'll be discussing a key trend that Kent is seeing with inventory creeping back towards what he would consider normal. And there are a number of areas where that could bring considerable risk.
Welcome to The Elephant in the Room. This is the podcast where we love to talk about the big things in property that never usually get talked about. I'm Veronica Morgan, real estate agent, buyer's agent and buyer's agent mentor, co-host of Foxtel's Location Australia, author of Auction Ready and co-host of Your First Home Buyer Guide.
And I'm Chris Bates, mortgage broker, recently ranked number 5 in Australia out of over 18,000 brokers in the annual MPA Top 100 Mortgage Broker Awards. Before we get started, I need to let you know that nothing we say here can be taken as personal advice. We always recommend you engage the services of an appropriate and experienced professional.
This month, we've asked Kent to look at what's happening with inventory levels and whether there are any danger zones across the country, I think particularly in tree and sea change areas. So, Kent, can you kick us off by briefly explaining how you've tackled this challenge?
Yes, what I've done is I've looked at areas where, or statistical area 3s, I'll just say SA3s because it's easier for me to say now. So I've looked at SA3s where we've seen a consistent rise in listings over the last few months. So rather than jumping at shadows, we've looked at that consistent change. Then what I did is I filtered out those locations that had lower inventory levels and just focused on stuff that was 5 months and higher. And what we've seen is most of these areas have kind of come off a base of, sub 3, like most markets around the country. Go back a few years, 4 and 5 were normal. What we're seeing now is a number of locations around the country where listings are rising, but average sales volumes are going the other way. And as a result, we're starting to see some inventory levels creep well and truly above 5, 6, 7 months and higher. And some of these locations are fairly dreamy locations. So
I just want to remind listeners, anybody who hasn't listened to your explanation of inventory levels versus stock levels versus listing levels, just so we can sort of clarify exactly what we're talking about here. And then we're going to get into this juiciness because this is really, it's going to challenge, I'm sure, a lot of our thinking.
Yes. So inventory level is a fairly standard metric used in North America. So typically, if you've got 100 listings on average and you've got 10 properties that sell per month on average, 100 divided by 10, 10 months of stock. If you've got 20 properties that sell per month, 100 divided by 20, 5 months. So typically, you've got two metrics that are important. You've got the absolute current measure of inventory, whether that's below 3, it gets pretty tight. That sums up pretty much the entire country. In most markets, we've seen, most suburbs, we've seen over the last couple of years, we've all kind of been sub 4 months, with the exception of a few of these house and land areas. So I just want to push the house and land areas out. So typically what we're seeing is this extraordinarily tight level of inventory, which has been a fairly common metric in the US as well, coincidentally. What's happening now is we're seeing inventory levels rise, and so their current levels are starting in some of these markets that we'll talk about in a moment. They're climbing up above the 6 months mark. So I'd kind of used to say 5 months was around the equilibrium or balanced market. I probably pushed that down to maybe 4 because we've been at such a low level for so long. So if you make the assumption, if you hold the assumption that 4 months is a balanced market, anything above that starts to see downward pressure on price. But you've also got another metric, which is what the trend is. So effectively, if things are changing rapidly in terms of inventory levels building, you've got not only the current level of inventory, e.g. 6 or 7 or 8 or 9 months of stock, but you've also then got the trend that's behind it. And typically this is a measure of supply and demand. It's as simple as that. And if you have the theory is if you have no other property list for sale, how long would it take at current levels of demand to clear out all of the inventory that's on the shelves?
And you think it's a bit of a tipping point, Kent, where the buyer goes, well, I've got a bit of choice on the market. Maybe it's 4 or 5 months, but not heaps of choice. But once it gets sort of 6, 7, they're like, well, there's no urgency to buy here. I can't see things, quickly going off the shelves. I'll be really patient for something that's good. And then, especially particularly get this sort of downward spiraling effect where, potentially people do want to sell because they're like, oh no, prices are falling. Maybe I need to get out before it gets worse. And, you start to see those real, big price drops that, that people have been thinking is going to happen to the Australian property market for years. But, reality is we could be, the eye of the storm for some of these locations that inventory is really jumping up.
I think it's the flip side of the same FOMO coin. So it's, the opposite of what we've seen for years now. We've all gotten used to markets that have been booming and growing at a great rate of knots. I think if they go down at those same rate of knots, there'll be some panic. I guess for me, the issue more is that, this is my theory. My theory is that these areas have been so tight for so long that they'll hit a price point where people will say this is really good buying and stem that downward flow. Whereas with the upwards price, you've kind of been capped. The ceiling's been more affordability, borrowing capacity has been the cap on the upwards. I think the floor on the bottom woods, I made that word up, is effectively you hit that magic price where it does appear to be exceptional value, whether that just be for owner-occupied, whether it be for a retiree looking to downsize and there's sufficient margin between what they're selling for in Sydney or other and moving to a Noosa, for example, or an investor. In some of these locations we've got listed down have been for a very, very long time listed as investor hotspots. And so that a lot of them have good yields. So, a downward price just makes those yields look better, especially where the rental market's healthy. Yeah.
Have you ever been to the fish markets and watched an auction for fish?
Oh, down at the Sydney. Have they redeveloped that yet? The Sydney fish markets?
Not yet.
Not yet.
No, that's another topic for another conversation. No, a lot of people say a Dutch auction, they use the term incorrectly. So a Dutch auction, it's like when lots of people are fighting over a property and it's private treaty and becomes a Dutch auction, right? It's not actually a Dutch auction. Apparently a Dutch auction is where this price starts high and then just there's like a dial and it just gets down and keeps going down and then basically people press the buzzer when they think, oh, shit, that's really good value. I don't want to let it go any lower because someone else will buy it. So it's the opposite to, like you say, it's opposite to FOMO. So I don't know if there's an acronym for it, but so that's how fish is apparently sold at the fish markets. And I think that's maybe how the fresh produce markets work. I'm not an expert, don't get up early enough in the morning, really. But so that's really like the catching a falling knife thing. That's when the markets really slide at a great rate. Now, we haven't really seen that happen. Maybe in mining areas, but even so, I don't think at any point anyone said, yes, that's great value. So I want to know, are the at-risk areas the usual suspects? You mentioned house and land developments, new house land developments. You mentioned you've taken them out of the mix because they are usual suspects. Or are they coastal areas like Byron Bay? Because, that's a usual suspect because it's far enough away from a capital of Sydney and it does have very large fluctuations. Or what are the surprises in the mix?
Yeah, what I've done is I started out with a list of 43. I thought we won't cover all of those today, so I'll isolate the really interesting ones.
No.
I picked out the ones that I've always eyeballed, the ones that I would look online and say, great spot to retire, etc. So they're the sea change, tree change locations that I'm making the assumption here that they ran very hot. Maybe there was a little bit of overheating as a result of that exodus, the COVID exodus. So that's my theory. When I'll list them all down, then we'll come back and pull them apart. So the first one's good old Noosa. And so I've listed them in price. So Noosa's up top of the list, followed by Noosa Hinterland and then Richmond Valley Coastal. We all know that contains good old Byron Bay. Queanbeyan. Now that's been one of those hotspots that I've picked many times for investors. So Queanbeyan's there, Coffs Harbour's there, Great Lakes. I'm looking up because I'm looking at my list behind the camera here, so that's probably see my eyes darting around. Great Lakes, Sunshine Coast Hinterland, Cleveland Stradbroke. That's that Redland Bay area down south of Brisbane or east. Shoalhaven, Orange, Bathurst, and the last one on the list is Hobart Northwest. So that's ranging from an SA3 asking price median of 1.372 down to 585 being the Hobart Northwest one. So it kind of gives you a list. Now, if you go online and look at listings in any of these locations, and you, especially if you order them from price high to low, you will see amazing views and vistas and beautiful houses. I mean, quite stunning. So all of these locations can offer up something amazing for you to look at. If you were looking to downsize, if you're looking to sell up in Sydney, which is still a pretty hot market, and look at an area that's suddenly offering up choice and offering up some, I'm going to use air quotes, bargains. Is it a good time? I think that's a good question, because you mentioned earlier, are these falling? How far have they got to fall? What are the risks? But I think by and large, I've been caught out before where I thought, remember Sydney went through a couple of downturns in the unit market in the last 25 years, and inventory level built up and then click your fingers and they came down again because investors flooded in, etc. The question I've got is, will the same thing happen here? What I'm not confident about is the fact that they're a little bit remote. So talking about the Sydney unit market 15, 20 years ago, a little bit different to talking about Noosa hinterland.
So I guess, it's a real worry though, is if you're owning a property in these areas, maybe you bought in the last couple of years, and, if you do need to return to the city, well, you're selling in a market that's completely different from undersupplied to oversupplied. Do you think that a lot of people are, the reason price falls haven't been as great is people just can't justify selling, right? Like, I know I want to sell. I know it's not worth what I want for it, but I'm just going to hold on and so basically people are, because the price falls haven't been that significant yet. But do you think there's a tipping point when everyone says, actually, I can't hold on anymore. I can't service the mortgage. I need to get back to the city for work. I just need to get out. And that will start to lead to much lower prices. Do you think it's, surprisingly, with that much inventory, 10, 11, 12 months of inventory, you'd expect much bigger price falls, but markets seem to be holding up.
They've been pretty good, but the price falls here, we're talking at, say Noosa, for example, the last 12 months is minus 8%. So it's just the annualized. So 8%, but we've seen a fairly significant spike in inventory in the last couple of months. So the question I have here is it possible that the worst might be ahead for these locations because of that inventory spike at the same time as the threat of interest rates going up again? I wanted to hold back on making any of these assessments or statements because of the possibility the interest rates had flatlined or maybe coming down again. But if they're going to go the other way, that borrowing capacity issue just becomes a major constraint to any further price growth. So the reasons behind this, I can't put my finger on the motivations for a lot of the people who bought and sold or who are likely to sell, but the numbers tell me here we've got areas that have not seen levels of inventory above 7 or 8 in years. And this is a great example where there was a time when Noosa was a market that did have fairly significant cyclical variation. Now, I made the incorrect theory. Well, I made the statement, I think, on this show that was gone from the market because of the work from home movement. Because a lot of the markets that were holiday home, the second home markets, were the ones that always had the greater variation in a downturn. Another example would be up at Nelson Bay. A lot of holiday homes, so people go and buy and push up prices during the holiday seasons, and then things would get tough and they'd all flog their holiday homes. Noosa was a similar thing. Noosa would have a bit of a significant downturn in the down periods. But I made the statement that I thought that was going to disappear as a result of work from home. I may have been wrong. That this variation looks significant.
We interviewed Eliza Owen a few weeks back, and she did say that there's it's not as significant enough that there's been a U-turn in a lot of these sea and tree change areas. So that short-term sell within, say, 2 years. So there's the post-lockdown sea and tree change, and then quite a high proportion of resales within 2 years. So there's definitely lessons to be learnt there. And the thing is, though, and it is interesting because I guess we look at COVID and we think, how has that made permanent changes to our lives? How has it accelerated change that was always going to happen but might have taken a decade versus how has it created behavioural change in people that isn't sustainable, isn't going to be permanent, such as that demand for sea and tree change, because we get bored with our city hamster wheel lives and we all yearn for a simpler life. We go and get that simpler life and it's not quite what it was cut out to be, or the work from home didn't materialise long term, et cetera, et cetera. So it's not unexpected really. But I guess the further you go from a capital city, right, the more vulnerable prices are. And I would think that's, or certainly once, I guess the further away you get from a capital city, the more likely there could be a U-turn if you are dealing with people who still have to work. And of course, that allows more vulnerability around that price. So are we seeing that? Are we seeing that that's sort of beyond the 2-hour commute?
Yes.
Is that sort of noticeable here?
It is. Like there's a couple of exceptions in this list. You've got Hobart Northwest, so not a far commute, but by and large, there's it's a bit like Brisbane. Anyone living outside of 10K out of Brisbane, they think you're living in another country. So you've got Cleveland Stradbroke, which includes Redland Bay, which is it's a solid 45-50 minute drive. And then Hobart Northwest, not as far a drive, but they're still out of burbs. So there are a couple of SA3s in here that I've picked that are out of burbs, but the rest of these, or Queanbeyan's in there as well, which is out of burbs of Canberra.
And Maitland's in here as well.
Yeah, I took Maitland out because there's a fairly big proportion of new house land there in that mix.
New housing, yeah.
So I removed it because it's skewing the data and it's so hard to measure. But yeah, the ones that I've left in it as my focus point were all these beautiful locations, that the emotional purchase had a role to play.
Well, I guess it's a double risk, right? You're a little bit further away from the city, and B, you're getting a lot of new housing stock, right? So you've already got a lot of inventory, a lot of listings on the market. So as a buyer, you've got lots of choice, and then you could buy old or you could buy new. And as a buyer, you're like, well, there's no rush, right? I don't have to buy because everything's sitting on the market, and I'm going to make lowball offers. And I think maybe the market isn't willing to meet those lowball offers because they're able to hold on. Investors, but I think at some point people have to meet the market, generally their situations, and then prices, that one person who couldn't hold on had to take that offer for 700 because that's the best they had, and even though they wanted 800, and then goes, well, everyone, that sold for 700. Why would I want to pay more than that? And you start to get this fire sale repricing of the market. I'm not sort of saying doomsday, but this is what happens in oversupply. Unless supply really kicks up, you don't get those real buyer conditions, what everyone thought would happen in COVID. Everyone thought the mortgage cliff would create these sort of situations. But I when I look at these inventory numbers, 10, 12 months of inventory, in particularly in these high-priced, sister cities to the capital cities, I think it's a real concern. Potentially a buying opportunity if you're wanting to make that lifestyle shift down there. Maybe you can be patient and really wait for that right property, which you may not have the option to do that the last couple of years. So sell at a better price in the city, and but where really concerns you the most, Ken, in this list, you've obviously got massive, outback Queensland and things like that. But on the higher end price, what's really, do you think, is it Noosa that looks the worst, or what do you think?
It's the suburbs within these regions where we're getting to very, very high price income ratios. So effectively, if you look at, I've just got another list here where I've sorted out based on buyer affordability, or how many years of household income does it take to cover the median asking price. And you're talking at, say, I'll pick on the first one there is Byron Bay. Now, Byron Bay is 28 years of household income. Now, yes, there are some high income people captured in that, but it's a bit of a mixed bag, and still, so it's a very spread, different distribution of income there. But forget about that for a moment. And then the next one down there is Noosa Heads, and we're talking 17 years. And then we're talking Sussex Inlet. We're talking 16 years, etc. So we've got A lot of these areas are pretty much the bulk of the suburbs in these areas are talking 10-year plus. So on any national index of measure of affordability, once you get above 10, you're in the red zone, not affordable.
I was about to say, what's our benchmark?
Yeah, well, on global standards, I've heard as low as 7 years is the normal. So
right. So, and this is basically where areas become unaffordable
for first-time buyers and upgraders. But I think that, these areas will only continue if they've got a lot of downsizer or cashed up money coming in, whereas the last few years they've been pumped up because A, they've been buying, and B, the younger family, the high-income people have been buying as well, and they had much bigger borrowing capacities there. So they really can't buy in these locations because the capacity's not there and they don't want to.
But also downsizers have a double whammy here because they often can afford to spend more on their housing, but they don't contribute to income. Like they don't, they've got lower incomes. So it's a bit of a double whammy there.
It is. Tweed Heads is a doozy because you've got a very, very low, the suburb of Tweed Heads or Tweed Heads South, you've got a really low household income and you've got some pretty high-priced properties, so depending on what sells at the time. So because you've got so many retirees in there. So the retiree market throws things out. The other one is the rental market. I know we're not talking about it today, but that rental cohort is a lower than average household income. So when you're doing these kind of rental affordability measures, they're always grossly understated when you use the household average income in most cases. So it's a fascinating scenario here, but I still hold the theory that there's going to be a bit of a flaw in this because a lot of these areas are so attractive that when they start to offer up good buying, they'll get a lot of attention, especially these C and 3 chain spots.
One of the things that I'm looking at this list and, listening, I guess I worry about the listeners can't see this list. So, but Liverpool, right, have gone from 6 months to 11 months of inventory, right? And their median price is 1.3 million, right? Now, 1.3 million is tough. That's really hard to, because if that's a lot of first-time buyers who haven't got a lot of intergenerational wealth, and we haven't spoken about that a lot on the podcast, but I believe that's one of the strongest reasons why the market's held up over the last 12 months is the money that's coming down from parents and grandparents. And in those areas, you might assume that maybe there's not a lot of, and so the borrowing capacities in those areas would have fallen 30-40%, right? And potentially more. You might have unemployment, you might have, young families as well that is reducing incomes. And prices have only fallen 6%, but now inventory is really kicking up. So you could say that, do you think that's a real worry tent where you've got, inventory really kicking on and it's an area where it's got a really expensive price?
Yes, that would be a biggie because, these are areas that I can't fathom how a lot of these markets got to the $1 million point.
But with that, are you just looking at housing data here or housing
just houses,
total,
not units,
all dwellings?
Just houses, yes. And there was a lot of speculation around Liverpool the last few years with the airport, the Airtropolis or whatever you've called it. So, the question is, what did that speculation create a little bit of overheating?
Particularly under, 2% interest rates, a lot of people moving to those areas could borrow 6-7 times their income. Now they can, interest rates are 6%. Now they can borrow 4.5 times their income. Now inventory is, really kicking up, 6 months of choice now to 10 months of choice. Maybe people are holding on, right? And, then you're going to start to see, you could see this pocket of Sydney potentially getting a real, not a complete buyer's market. And then other parts of Sydney under 1, 2, 3 months of inventory. Do you think that's what's basically playing out, Ken? It's a slow-moving thing where markets.
Yeah, historically, I'm going right back to the 90s when I was in the mortgage insurance space. The southwest of Sydney was always our red zone. It was always our worry. So when things got tough, it was where we paid probably the largest portion of claims in the country. It seems that may not have changed. It was just a little bit of a hiatus.
So, and I've scanned through the list and Liverpool and Northwest Hobart were the only two really that are within a major city. We talked about a few that are close to a major city, handful. Maitland you didn't put on the list, but Stradbroke area. Most of them are sea and tree change areas. Most of them are expensive because basically, I think you've made a note in our notes here that those in the list with the area medians of 750 and above have been hit harder.
Correct. They've done the big price adjustments, yes.
But at the same time, when you look at capital city prices, certainly I'm looking at Sydney prices, for instance, we've had a rebound this year, and the top quartile has done better than everything. In fact, done better than the rest of the country. So, it's sort of, and this is where, we're sort of entering back into almost normal territory now where not everything does the same thing. 2021, the whole market seemed to perform the same way. Regionals outperformed capitals. Other than that, everything was going up.
Yeah. And anyone could be an expert. Anyone could.
Yeah.
And that's the danger,
yes.
Right?
Now we've got more of this odd anomaly, sort of behavior going on that causes us to stop and actually look at it and say, okay, well, let's look at why obviously maybe this should be called the heat map, the hotspot map, where areas where prices have overshot the mark by the sounds of it. Overheated map. It's the overheat map.
Yeah, and would it have happened if we didn't have the cost of living crisis at the same time? Obviously, that correlated with the interest rate rises, but I think people borrowed. Money was almost free, so people could borrow very, very heavily. And, the question I've got now, I'm showing my age, the old Henderson Poverty Index and, the buffers, were they adequate? Did people lie a little bit on their mortgage apps or were the systems and calculators inadequate?
Yeah, but there's also another question. I mean, because yes, that could be that, but it also, the vast majority of these areas that are showing this increase in inventory are these lovely, desirable sea and tree change areas. So is it more around that, okay, a lot of these people potentially have bought in recent times because they are the city migrants, and that's changing behaviour as well, and potentially they're having more of an impact because of that. So it's hard to tease all that out. I can only myself, when I was filming the show Relocation and Location back, we started filming 2010. We filmed right through to 2014. So in that period of time, certainly the 2013 and 14, the market turned. Certainly it turned in Sydney first, and then it started turning in Melbourne, and we found it very, very different market conditions to what we were experiencing at the first couple of years of the show. But those regional areas, so and I'm including the northern beaches of Sydney here as a regional market, because that was very much behaved like a sea change market back then. Byron Bay, those areas, Cairns, even Hobart, these were areas that people would always love to go to holiday in and would love to dream of living in. But we were post-GFC. This is a period of time where everyone had offloaded trying to offload their holiday homes, and we're still trying to offload them years later. Byron Bay, certainly we filmed a lot up there. We filmed in the Sunshine Coast. We filmed up in the, Cairns area. There were houses being sold for less than replacement value. People were taking huge hits on the sale of property. And some of these properties have been sitting on the market for years. And that to me seemed like a particularly tough market, but on the back end of the GFC. But I often wondered, how long does it take to sell expensive property in regional Australia, And are we returning back to those times?
Well, I think we may be, because you're not going to be selling too many of these properties to locals because they've detached themselves from the local market. Yes, there are a handful of yet too expensive, so they're very dependent on the retiree downsizer. So what might save them though is, so there's enough of them though. There's a very large proportion of people who've been looking at these markets that couldn't find what they wanted. There was nothing available. So I think there's going to be a little bit of a safety net in there, because they still have all that, they're still attractive, they're beautiful to look at, and they're serving up some quality properties now.
I think what's interesting is that Byron, just released a 60-day cap with Airbnb, right? So, yes, you've got the cashed up downsizer, but you've got the high income
family that lives in the city that wants a pad that they can use, weekends, etc. And they may have said, well, I could make that work because I'll Airbnb it 6 months or 9 months. I'll use it 3 months. So it's really almost like a second home / holiday home for them. But if you've got all these locations that have got rental crisis, then they also bring in short-term caps. Then that person says, I can't afford to hold a holiday home or a second home in these locations because I'm not going to make enough money to cover the mortgage at 6%. So then you wipe out the CT range, the high-income investor into these areas, and you're down to the soul is that cashed-up downsizer. And do they then, in the past, thought maybe the kids would follow them to those locations, but the kids are like, well, no, we have to stay close to the city now because, hybrid work, remote work's not a thing like it was. And maybe the parents don't make them, the grandparents don't make the move. So, yeah, I think it's quite concerning, particularly when, listings increase, that who's going to buy these things if more and more choice comes on the market.
Well, I would argue that there's a very large proportion of these, specifically those that are, say, below 500K, that if they drop a little bit further, they're already offering pretty decent yields for houses. So there's a lot of investors out there that are actively always looking for the under 500K house. So I think that's the second opportunity. They're desperate to buy houses and they're desperate to keep to a budget. And so as long as it ticks the yield box, a lot of them jump in.
Yeah, the investor sort of high yield buyer's agent, right? And they put it all over LinkedIn, all over the different channels, right? I'd love to say, one of their metrics is, well, how much is inventories in that location, right?
Yeah.
Because, what's an easy way for people to figure out how much inventory is in the market they want to buy? Like, what do you, accessing free data, Ken? I mean, not everyone's got access to RP data and all the portals, but what do you reckon an easy way for someone to do it? Do you reckon there is a way to do it?
You just got to work out how many properties are selling on average. And come up with that. So that's a projection because you don't know exactly the sold count until a month or two later. So if you look at the sales history and you come up with an average, you can do that visually pretty quickly. So you can come up with, okay, what's selling in that suburb? And then you look at how many listings there are currently. There you go. That'll give you the current inventory. That's just for the suburb. I don't like to do it just at the suburb level because you can jump at shadows.
But you could, though, if you had a concern, you could bring up the New South Wales Land Registry site and then bring up all the sales over the last, I'm not sure how far it goes back, actually, maybe the last 1 or 2 years, and then see what's roughly how many houses are selling per month. And then you could go online, look at the portals, even though that's not all listings, right? But you could look at the portals and then say, actually, 15 houses are selling a month and there's 60 on the market. Well, I've got an issue, right? Well, that's only 4 months of inventory. So
I think the issue comes, the issue really is, I think now these 6 and 7s and higher and growing, where we're seeing sales volumes dropping month on month by about 5% in many of these areas at the same time as listings going the other way at a similar rate.
Can you explain that a bit more, Ken? Because that's actually another point, right? Not only is there a lot of listings, inventory building, but we're selling less of them. We're actually lesser transacting, at the same time as more stocks building. So, things are just getting fatter and fatter rather than cutting down.
Yeah, so we're looking at my sea and tree change. I'm saying that slowly list that we mentioned. Across that, the average there was minus 6% over the last 3 months. So the typical monthly delta, the monthly change in sales volume, it was a drop of 6%. Month on month. So a significant fall in sales. Now, there are some assumptions that need to hold there because I can't see what sells until it sells. So there's a bit of a boogity that goes into projecting what it's going to be this month. But with listings, it's a bit better because you can effectively, what I do with there is I've grouped together all the suburbs per SA3 in an REA search. And then what I do is before I do my final calculation, when I do all the shortlisting, I go and do a current house listings count. So those counts that you see there on that list, and the listeners have to trust that we've got a list in front of us, they're actually from yesterday doing a count real time. So the listings counts are real time, and they have been going up as well. And they're pretty much going up at a very similar rate to the sales volumes are going down. which is leading to this fairly significant jump.
I mean, we keep saying C and tree change. I don't know what orange is. Is that like a...
I'm calling that a tree change.
There ain't no C. There ain't no C at
You
orange.
reckon maybe it's just a winery change? You can't call wineries trees,
But
though.
beautiful quality houses. So you're getting
And a lovely town.
beautiful vistas, high quality houses, some good employment. So Orange has been the poster child for a lot of investors and advisors for years, and it's all the metrics have held up. So those who have picked out Orange in the last 10 years have done good things for their clients. There's no question. It's been a golden child. It's just going through a bit of
That's gone from 6 months to 9 months of listings. So out of all this list of 30 odd, that's the fourth largest or the fifth largest big jump in listings as a percentage, together with Liverpool and the Great Lakes and Yass. When people said the winter supply was, listings have really jumped up, 2 months ago, I was like, I don't think that's going to stick around. I think people are just selling earlier this year than they would have. They're trying to front run the market, right? And that's ended up what happening. I think listings have almost just got back to trend, if not below. But when you look at somewhere like Orange, it's gone up 45% in the last, month.
But its price has only dropped by 1%. So the question is, are people holding on to your point earlier? Are people saying, no, I'm just going to keep holding, and that they're not meeting the market? So there's, that's what appears to me.
It comes back to motivation for selling. And if it is the U-turn type seller, they've only been in that market a short period of time and they're going to hightail it out of there, they've got a very different motivation than somebody who's selling their acreage or their home because they're ready to downsize or whatever, or upgrade. And the country areas, typically have taken longer. Their days on markets in country areas has typically been longer than in cities. That's a normal sort of expectation.
Yes.
Yeah. So therefore, if we knew what the cohort was that was selling, it could just be going back to things as usual, things as normal, or it could be that you've got a bunch of people with a different motivation. And also, if anyone has gone and paid overs to do their tree change, realise it's not working for them, got to sell, going back to the city. If they see the Sydney prices, for argument's sake, if they've come from Sydney, if they're seeing Sydney prices on the rise and they're seeing prices where they're selling either flatlining or falling, they've got very different decisions to make in terms of opportunity costs, et cetera, than somebody who is going to downsize in the same area. So that'd be it. So I guess it's just watch that space to see if what sort of buyer is, or what sort of seller is selling.
Yeah,
perhaps.
and you look at these are spots that I like to look at in terms of listings. And for years, I've always looked at places like Orange, saying, "Oh, that's expensive." So I think for a lot of these locations, they're rather expensive properties against what I was expecting. Beautiful properties, don't get me wrong, but even Bellingen, I look at Bellingen as my benchmark for a lot of things, and so many properties selling above $1.2 million, and it's like, oh, that's kind of reminds me of what the Inner West was 10 years ago. So I just wonder how far they've jumped beyond the local market and whether they're entirely dependent on out-of-town buyers.
Is Bellingen included in the Coffs Harbour?
It is
accessory?
in the Coffs Harbour, yes. And there are a few extra properties, and I went up to visit a few days ago, having a scout.
Did you? Why did you specifically go up there? Because you're thinking that might be your time to
Look,
bounce.
I'm so ready. I'm so ready for a sea or a tree change myself. So there is a bit of motivation behind me doing this. But the main reason was to take my beautiful daughter away for a father and daughter trip. So it was just a couple of days with my beautiful girl. There you go.
And Bello is a beautiful place.
Yes. Well, we went up to Dorrigo and did the rainforest walk, and then we went to Urunga and did the walk over the water there, and it was crystal clear but too windy. Ice cream, we ate ice cream, all that jazz.
Very nice. Well, I was down in Hobart, so I was checking out that landscape.
Well, it's a soft market. That's soft.
Yes.
Yeah, and I think what all this stuff really aligns, Ken, to what we're seeing, right? So we see a lot of those younger families that are living in the city or trying to solve their lifestyle and home ownership dreams, right? And before 2020, not many wanted to leave the capital cities. Like we'd talk about Central Coast or Wollongong or Mornington or Sunshine Coast or Gold Coast, and most of them wouldn't even look at it. They talk about it, we'd have a conversation, there would just very few would go ahead. Obviously, that completely flipped in 2021. Then we saw it really wind back in 2022. And then this year, it's almost non-existent, to be honest. The confidence in people making those big lifestyle moves, and then those interstate moves, the Sydney person going to Brisbane. I just don't think that's driving the Brisbane market, even though it's recovering. I don't think it's that interstate migration, which was driving it a couple of years ago. And we're not really seeing people, particularly if it's, that second, 2 hours away from the city. So someone would much prefer to buy in Sutherland than they would north of Wollongong. Like that just seems too far. Whereas 2 years ago, it didn't seem far at all. The Central Coast as well, a lot of people are saying, oh, I'll buy it there, but I don't want to move up there yet. I only want to do it when I have to. Whereas 2 years ago, they're like, I want to do it now because I've got flexibility with work. So, I think this is really starting to play out. And, I think also people don't really want to make those big lifestyle moves where there is a bit of uncertainty, right? Even the older generation, right? So, maybe they go, I'm not sure what I'm going to sell my Sydney place for at the moment because there's a lot of negative news. This also seems too hard. Let's just stay where we are. Maybe they need real confidence in the market. So, but maybe they'll get that. Maybe they'll get that when Sydney prices go up and it's a much more affordability driver. I could downsize, bank $1 million and live a better retirement, and I can put in the interest rate and get a 6-7% return.
Well, I think the 300K gap for super is a standout for me. That downsizer incentive to say as soon as, and the issue I've had is if you do that and you're not really banking 300 to 500K and the gap is smaller, there's a disincentive to do it. So when you look at these markets and, look at Orange and hang on, that's $1.2 or $1.3 million or Bellingen or wherever. If there's not much of a gap, then that's going to be a reason not to do anything. But I think if these markets start to come off just a little bit further and that gap does get to that 300K plus mark, I think they're going to be rather attractive to the downsizer because you've got choice and you're pocketing some money.
We shall watch this space, but I think it's important as well. I mean, the inventory levels is one thing, but I think a long-term average would be an interesting thing to compare it to.
Yeah, absolutely.
Yeah, rather than, because of the recent times, we've had so much volatility that it's actually really hard to, everything seems long. Everything seems like a lot of inventory compared to what we've had of recent times. So I guess that's what I'd be looking at. I think it is interesting too that the capital cities just haven't really featured. And I think that is a really interesting observation. It does seem to me, I mean, I know when sort of COVID first hit and that massive sea and tree change was almost immediate. It was almost like this massive untapped desire, which potentially fantasy. But the other thing I thought of with COVID too, when it happened, and I thought no one's going to want to live in a high rise ever again. No one's going to ever want to get in the lift ever again. We've all got short memories. We're all back to, what we were doing before. And I think this seems to be the same thing. It's just that we've all gone back to business as usual. And it's amazing how short memories we've got, isn't it?
Yeah, but I think that the pricing here is the hangover. That price has peaked. You had very limited supply, only so many builders that you've got in these locations. So people came in with surplus and pushed prices up, and that they need to maybe come down to a more natural equilibrium that aligns with local budgets.
Yeah. And so how would we work out what that could be? I mean, you know what I mean? Is there a way, do you think, to calculate that?
Well, you'd have to make a few big assumptions, but one of those assumptions is that I could peg it to local household income. So, you'd apportion the market and say, okay, there's going to be a proportion of out-of-town buyers and secondary buyers that can afford 15-year plus household income, different market. But then, you probably need to kind of split it up and say a certain percentage of the market, maybe do it in quintiles, whatever, But you can't dismiss local household income. That's my opinion. The big part of these models. And you detach yourself from that, you're totally dependent or heavily dependent on the out-of-town money. And that out-of-town flow has fallen away. It's not going to disappear, though.
And I think you also potentially open up a risk, right? So if it's a high multiple, very high multiple of local incomes, then their wealth is a lot tied. The people who own property in that area will go, well, my income's really low, but my property's worth a lot. And it's tempting in those situations to take your money and run. And so I reckon that's also happening in these locations as well, where, like a place like Kiama, right? They wouldn't have thought their house was worth 1.8 million and it was worth $1 million, 2 years ago. Well, do we just bank and take our money and run because our income's $100,000 a year and that's would set us up for retirement? And so maybe that's happening as well right now where, and they may be getting cost of living pressure and, higher interest rates. Well, yeah, I could hold on, but I'm just better off to bank it and buy something cheaper. So maybe that's starting to play. Whereas, maybe people in the city don't have that ability because there's nothing they can trade down to. Well,
it's interesting. A lot of locals have multiple properties, so they could have cashed in. A lot of them can cash in. There are a lot of people here in Newcastle that have been around for 30, 40 years buying houses cheaply. So there's a whole stack of people, on this street alone that own 3 or 4 properties, all because they bought them for under 100K.
Yeah.
And so they might be opportunistic perhaps, or they might be the people that never sell. But I think the problem is the theory that you've got there, Chris. If people are thinking, okay, well, I've sat on this property for so many years and now's the time to get out because, we're over the hill, we're over the peak. They also may well take their property off the market if they're not going to get that result as well.
That's
so
true.
It's that's where it comes back to who's selling and why. And so I guess if we'll watch this space, we need to probably review it in 3 months and see whether it's continued on this path.
Yes, I think that would be a good move, and we can track prices. I think the metric that I wanted to bring today, and I didn't, sorry, I wanted to look at their peak. So go back a few years and look at the peak, peak to current, and see how far. So yes, we've seen 12-month price changes, but what's it dropped post peak? And the peak, a lot of these markets peaked back in around 2020.
And if you can I guess get what Veronica was saying, long-term sale history, right? Is there any way to find out what's the average over maybe not just the last 2 or 3 or 4 years, maybe over the last 10 years of the number of sales on average of houses in that, and how. And then we can basically get a real good understanding of inventory, right? Because not only over the short term, inventory looks pretty average, but over the longer term, it also looks average. So,
well, yeah, and the norm's have always been 4 months, 4 to 5 months has been equilibrium.
Yeah, the norm. Yeah, but that because you've always said that that 5 months is a tipping point in terms of inventory, but that's aggregated for the whole country, right? I would think that that's longer in like a normal market. Conditions are longer in or more inventory in some places and less in others. Would that be fair to say?
Look, I think by and large, I think 4 months is a pretty good measure irrespective, no matter whether it be a unit or a house or regional or whatever. Days on market be different, because a lot of these regional rural areas do take an extra 30, 50 days to sell because they're unique. But inventory is pretty good. I think it's a pretty solid metric where that's why I like it, because you can roll different areas together and aggregate different suburbs. So, Richmond Valley Coastal, as an example, you got the really expensive $2 million plus suburbs, plus you got a few that are sub 600. You can roll them all together and have a pretty robust inventory measure.
Yeah. Well, it's what I love these conversations, Ken, because we don't just sort of take it on the surface of it. We love to interrogate it and dig and prod and probe. I know sometimes you think, shit,
Well, I'd love to know the motivations. Wouldn't it be great to just hit a button and know who's selling and why, and who's buying and why in these areas?
I know. Imagine if we get that info.
Yes.
Fantastic. All right. Well, you're going to come up with some other. Well, we shall talk about offline. We'll talk offline in terms of what we're going to come up with in our next Suburb Trends episode. We hope you've enjoyed this one. And these are the areas to watch, I guess. And if you've been thinking about sea or tree change and these are on your radar, then keep an eye out. Maybe there's going to be some good buying coming up if these indicators are pointing in the right direction.
Thanks so much, Ken. Talk soon.
If you have a question that you'd like us to answer in an upcoming Q&A episode, you can send us a voicemail or written question via the website, theelephantintheroom.com.au, or you can email us directly at questions@theelephantintheroom.com.au. If you like what you're hearing, please share this episode with others you feel would benefit. And while you're at it, why not leave us an iTunes review? 5 stars would be great. I know that sounds a bit cringy, but we have it on good authority that every review helps make it easier for other people to find out about us and hear what our amazing guests have to say.